Hey everyone, this is Russ here from the Morrison Mortgage team, and I just wanted to give you an update on what happened last week. The Bank of Canada did decrease the prime rate by a quarter point. So the prime rate for us civilians, as I say, was 7.2. Now it's 6.95%. So we do have a bit of relief at that point in time on our payments. So for those of you that have a variable where the payments change, they will come down by for every 100,000 will be about $13 per month. It's not huge, but there's more to come. So that's $13 for every 100,000 approximately. So this is the first rate cut in almost 4 years. Now, how this looks here is that in the past, we've had rate cuts be very significant. Okay, so they've gone up to curb inflation, they've come down. Here, we're probably looking at something more gradual. Okay, so not as significant as these rate cuts, but it's likely that these will be gradual. And what happens here is that these rates are expected to end up, maybe going down by about 1.5 to 2% over the next couple of years. So they are expected to be gradual. So they should end up maybe around here. So that means we'd have a prime rate about 4.5 to 5.25 in the months and years to come. So what does this all mean? Why did this happen? Where are we headed? Now, Canada's economy grew by 1.7% in the first quarter. It was way off the estimates by the Bank of Canada, estimating that would be about 2.8%. And also, economists had mentioned that it's way below what they expected as well, which I think was around 2.2%. Okay, so this is one of the big reasons I believe that the Bank of Canada is starting to lower rates at this point, is that it's not if the rate increases are working, it is they are working. Now, inflation. Here's the forecast. Okay, so right now we're at 2.9, it dropped down to 2.7, and the forecast is for this to begin dropping. And I think as the rates begin to fall, the cost of living in that will begin to fall, and that will be a big indicator of getting inflation down. Now, here's the thing is that the challenge we have right now is, do we take a variable, do we take a fixed? But these are bond yields. These are how fixed rates are priced, and this would be for a 3-year fixed rate, and these are pretty popular right now. Now, the challenge I have is that we see a big trend here, and it's like a roller coaster right now. But what we have here is after this happened and the expectation was much lower, all of a sudden we have these bond yields fall. Okay, now this would drop the fixed rates as well, so we will begin to see fixed rates fall. But what we think is, what is going to happen is as the prime rate begins to fall, is that these bond yields will end up, falling as well. So that's one thing to watch, is jumping into a fixed rate right now or a variable. I like the variable, but everyone is unique in what their needs are in that. But this is just something to watch, is these bond yields, and I'll keep you posted on that. Now, another thing that the Bank of Canada is watching is the unemployment rate. Now, this here is the forecast is to go up. So this is, unfortunately, where they want it to go. So what do we have, in the future here? What I want to do is just compare a few different rates here. Okay. And right now, let's say 3-year fixed rates are about 5.14. We can get a variable for prime less 0.95. I factor in rate cuts. Maybe there's one in July, but I factored in about 1.25 over the next, 16 months or so. I've done that for both this variable and also for the Scotiabank. Now, it's important to note that when you compare all these products side by side, is that with the TD product, is as the prime rate begins to fall, the payments don't fall. It's the amortization. So for those of you that want to take a variable right now, is a true VRM is at like TD or most of the banks, or if you want to pay down your mortgage quicker and you're happy with these payments, that's a great way to do it. For those of you that want payment relief, what we have here is, as the rates fall, your payments fall. So your amortization stays the same. So this is why when people come see me and they're like, what should I do? Is we've got to go through a bit of an analysis on what to anticipate, okay, and what their needs are. Because strategically right now, I think looking at, a variable and then watching the bond yields begin to fall and then locking in could be a very well like a good strategy, because this 5.14 could very well be 4.5 to 4.75 in 6 months. So you can see, looking at these side by side, is that when we account for monthly adjustments or the prime rate adjusting, is that down at the bottom, you'll see as compared to total monthly payments, they're about $9,800 higher here with the true VRM. but you paid off more. And that's because that payment has stayed the same. And your interest calculation is you're in the green. Now over here is that your payments are slightly higher, and it's almost the same because you're, same as the 3-year fix, because what's happening here is that your outstanding balance is very similar and the interest. For those of you that want to have payments begin to fall, that's an important one, is just the difference between these two types of products. So if you're having any challenges, and I've said this in the past, any challenges or want to go through like a needs analysis or just see how you sit, if you need payment relief or anything like that, there are ways to do that. If your mortgage comes up for renewal, please consider these items here. Reach out to us. We can help you with that. And if you have any questions whatsoever, never hesitate to reach out. And have a lovely spring, summer, and I hope to chat with you soon. Take care. Bye.